Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Treasuries rebound as weak U.S. job openings data reinforces bets on a Fed rate cut. Christopher Waller says the central bank should cut this month and continue. Chinese stocks slump as Beijing weighs measures to cool stock market speculation as concerns about a rapid $1.2 trillion rally mount. Plus, U.S. President Trump asked the U.S. Supreme Court to uphold his global tariffs after federal court ruling deems them illegal. Well, it's just gone 8 a.m. across the Emirates. I'm Joanna Bersetchi in Dubai. Things stabilized overnight for U.S. Treasuries. We actually saw global fixed income rally back. So that was the big story yesterday. What goes up must come down. That's the law of gravity. That's what we're seeing with U.S. Treasuries this morning. We rallied about 6 basis points, 10-year yield sitting at 4.22. So some calm being restored in those markets. S&P also, you can see, leading towards the green. A better session yesterday. The Nasdaq actually ended the session up 1% higher yesterday in trading. Very strong price action in Alphabet, as we spoke about yesterday, with the antitrust ruling in their favor on Chrome and their search engine. So that stock was up 9%, driving some of the gains in Nasdaq. Eurostoxx futures also leaning sideways, but again, in light of the global fixed income rally, we are shaping up to see a better positive session in European equities as well. And then Brent also in focus. $67 is where we're at, down 0.7%. We're heading into an OPEC Plus virtual meeting this weekend. Will more production be potentially put back to the table? One of the big questions for investors, as you see the likes of Goldman Sachs and other analysts around the world maintaining their bearish view on the price of oil and where it can get to, with Goldman saying we could get to low to mid-50s by mid-2026. Flipping over, we've also spent a lot of time talking about all the money that's been pouring into gold. So just take a look at the inflows. I thought this chart was nice to take a look at, mainly because it encapsulates how much money has been going into the gold ETFs. And you can see just in the last couple of weeks, an extreme amount of volume has gone into that space as we speak about gold making new record highs, reaching through $3,500. Remember, it's not just gold, but also silver, too, the highest level since 2011, breaking through $40 an ounce. So gold and silver beneficiaries of all of this global uncertainty and also the expected Fed rate cutting cycle. Okay, let's check in on how markets in Asia are faring. Annabelle Jewelers is in Hong Kong. And Bella, I started off talking about the global fixed income rally, but of course, we did have quite an important 30-year JGB auction. What was the latest there?
Yeah, that's right, Jemana. Coming into the session today, this really was one of the key themes that we were going to be tracking here, because we had this Japan 30-year bond sale and lots of questions going into it. What exactly was the demand going to be looking like? Because, yes, you've had those global gyrations, lots of concerns around the health and whether or if governments are going to be prepared to rein in their spending worldwide. But in Japan as well, you've got domestic pressures at play and these questions around how long Prime Minister Ishiba can hold on to his power. Would there be any sort of moves as well for him to be stepping down? So that is certainly playing into the dynamics as we came into the session today. The results of this auction, a reading below 3 on the bid to cover ratio was going to be interpreted as a bad sign for markets. Actually, though, it came in around that 12-month average. So the bid to cover ratio 3.31, a little bit lower than what we've seen in the past 2 auctions, but still, when you compare it to that 12-month average, it's around 3.38. So 3.31 interpreted as not too far away, especially when you consider not just those global but the domestic dynamics as well. So off the back of that, you've seen the yield on the 30-year a little bit lower here. Equities are rising as well, and Topics Bank's the big beneficiary out of this, the financials. But let's also change on, because I mentioned Japan was sort of the big theme coming into the session, but there is a story that's probably, I'm not going to say have eclipsed, but it's certainly running on a par today. And this is actually a Bloomberg scoop that we had. China is looking at ways, we're hearing from sources, to curb this huge rally that we've seen in stocks. So you're talking about a $1.2 trillion rally since the start of August in China. Now there's this question, are authorities or regulators in China a little bit concerned that we've gone too far, too fast? So they could be looking at measures to try and curb, for instance, speculative trading, looking, for instance, the amount of margin trading as well that we're seeing. So that is having certainly a big bearing on what we're seeing in terms of trading activity, because just this report alone has sort of been enough to curb in, anyway, a lot of the market frenzy that we've seen. Lots of moves here to the downside, and you're seeing it really impacting some of these stocks, these more growth, innovation-led stocks that have been some of the biggest beneficiaries over the past few weeks.
Yeah, and as one of our MLive colleagues put it, it's transitioned to a self-curbing mechanism because nothing has been announced, but the market has decided to sell off anyway. Annabelle, thank you so much for the update. And of course, big story in China driving the price action over there, Annabelle Jewelers in Hong Kong. Well, President Trump is asking the Supreme Court to uphold his global tariffs in a fast-tracked case that could reshape trade policy. Bloomberg's news desk editor Balazs Pence joins us for more. Well, Balazs, clearly the president wants some clarity on the tariff situation. What does the latest filing tell us about where this case could go?
Well, Jumana, we knew that the White House would go straight to the Supreme Court when appealing this case. There are a few takeaways from this filing that we found out. The first thing, as you said, they're asking for an expedited procedure. They're asking for arguments to start in early November, which would allow the court to rule by the end of the year. So that gives us a bit of a timeline. We also find out a little bit more about the administration's legal strategy here. One thing they argue is that striking down these tariffs would cause irreparable harm to the U.S. economy. It would cast a pall over the economic planning and policies of President Trump, and it would deprive the administration of its ability to respond to trade threats. As to the merits of the case, they argue that the U.S. trade deficit does constitute an economic emergency, which is what the president used as the basis of his authority to impose these tariffs. And that's exactly what the lower courts found that he did not have. So that will be at the very heart of the case when the Supreme Court does start deliberations.
Okay, so if, and this is obviously a hypothetical question, but if the Supreme Court rules alongside the lower courts and that these tariffs are illegal, what knock-on effect is that going to have on these new trade deals that the U.S. has inked with various countries around the world?
That's right. The president said yesterday that striking down these tariffs would mean unwinding those trade deals. And just remember, a lot of time, a lot of effort from all sides, from a lot of countries around the world went into getting those trade deals. But look, on the face of it, no tariffs, no problem, right? That would be good news. The U.S. still has some of the highest tariffs in the past 100 years after those trade deals. So on the face of it, that could be seen as a relief for those countries. But we know that the U.S. has several avenues to try to get back to those tariffs, to reimpose them through other legal mechanisms. So likely that would set off a whole new round of uncertainty, and these countries would have to go back to the negotiating table potentially and try to get those same deals. So it would open up a whole new phase of instability in global trade and be another threat of instability for the global economy.
Yeah, well, uncertainty seems to be the theme of this year. Despite that, markets continue to make new highs. Bloomberg's news desk editor Balazs Pence. Well, speaking of markets, St. Louis Fed President Alberto Musalem says interest rates are well positioned for the current economic environment. While traders are betting on a rate cut as early as this month, Musalem says he wants more data before making a decision.
The current modestly restrictive setting of the policy rate is consistent with today's full employment labor market and core inflation nearly 1 percentage point above the Fed's 2% target. Looking ahead, I expect the labor market to gradually cool and remain near full employment with risks tilted to the downside.
Okay, that was St. Louis Fed President speaking. Of course, we did have comments from Christopher Waller overnight, perhaps one of the front runners to succeed the Fed chair, speaking very dovishly as well. To discuss this and more is Amol Shitole, head of fixed income at Mashreq Capital. Really good to have you with us. Let's start with the global fixed income rout this week that sort of recovered in yesterday's trade. What do you point that down to? Why did we get this big upset on the first trading day in the U.S. this week?
Good morning, Jumana. Good to be back. See, the global yields are rising, as you said, but then the reasons are not really inflation. It's not runaway inflation anywhere, be it US or rest of the world. I think it's more to do with the supply dynamics and really structural increase in term premium, right? But if you zoom out and if you look at the long-term macro drivers for the U.S. economy, they're still disinflationary to our mind. So be it impact of AI, be it subdued energy prices, which you talked about earlier on the show, be it aging population, we still think they're going to drive the long-term price action on U.S. Treasury yields.
So are you a buyer of fixed income here? And if you are, which part of the curve?
Absolutely. We like the yields at current levels. They are at cycle highs, be it 10-year, 30-year. Naturally, we are extending the duration across the curve. 5 to 10 year is really a really good spot to clip those coupons and wait for dovish monetary policy to play in our favor over the next 12 months.
But most of the investors we speak to are positioning as steepeners. They don't want to own long duration in the U.S. Are you not worried about that tide moving against you?
Absolutely. It's a great question. And you're talking about 2/3 steepener here, right? Yeah. And it's about 130 basis points as we speak. But if you look back to 21-22, it was negative 100. So we have already steepened by 250 basis points. So the big move is already behind us. I think these are the levels we got to just dip our toes back in and look for opportunities at the long end. We can't avoid this at these levels.
Okay, interesting. So that's your long duration bias. Let's translate that to credit, because obviously we've been speaking about how tight some of these credit spreads are trading, both in corporate credit and in sovereign credit. How are you identifying opportunities also specifically in this region?
Again, as you said, spreads, they are decade tights across the board, be it GCC, emerging markets, or developed markets as such. Having said that, if you look at the yields, they're at multi-decade highs as well. So I think if you lock in 5 to 6%, 7% kind of yields for 5 to 10 year duration, that's really an interesting proposition for investors at this point in time. Income is very, very attractive. Yeah. And we have seen that play out this year, the previous year as well.
Yeah. The big question mark for this region is Saudi Arabia and the huge fiscal issuance that's anticipated. Yesterday, we had the 5-year and the 10-year sukuk massively oversubscribed. It seems like investors can't get enough of this paper despite the worsening fiscal dynamics in Saudi Arabia. Why is that the case?
Again, I mean, if you look at the Saudi Arabia, it's still a strong credit story. We are talking about A+ rated economy. Debt to GDP is just 30% at this point. Even if you extrapolate the issuance level until 2030, that's the vision execution, market is predicting 35 to 40% level. That's not too high for this rated economy. If you look at the interest expenses to revenue, it's just 3 to 4%. Net foreign asset balance is positive 50% as per rating agencies. And if you look at A+ rated credits within EM, that number is just 35%. So if you look at the fundamental picture as a whole, it's still constructive. And yesterday's issuance, as you said, it was in sukuk format. It benefits from really solid technical backdrop as well, where investors are buy and hold. There's very high demand and very limited supply for A-rated or high-quality issuance as such.
Yeah, we've spent a lot of time reporting on some of the mega projects that Saudi Arabia have had to downsize on, whether it's at the Winter Olympics, whether it's NEOM, reprioritization of spending projects. Does that not make some investors wary about the extent of how much fiscal tightening is to come out of Saudi Arabia and the knock-on effects that this could have on the balance sheets in coming years?
Absolutely, and that's exactly what's happening. And if you look at the Saudi Arabia bond curve, people are hesitant at the long end of the curve there, where there's lack of demand, and considering the macro backdrop, it's very difficult to place bets on that. And as a result, if you look at the issuance calendar this year, so they have stuck to 5 to 10 year bucket and not really gone to 30 or 100 year issuance, which they did in the previous year. So 5 to 10 year bucket is still the cheapest single year risk in EM. And considering the credit profile of the economy, you can still look past the near-term fiscal noise.
Yeah, beyond Saudi Arabia, there's been a ton of MENA credit issuance this year, though.
Absolutely. Just to put it in perspective, we have about $93 billion of hard currency issuance in MENA. We expect $125 billion this year. That's going to be about 15% more than the previous year. And by the way, it's going to be the record year of issuance for MENA hard currency space this year. We expect to have this kind of range next year as well, considering how oil price trajectory is at this point.
But there is demand for this paper. That's the point, even though there's more of it coming. The orders, like we saw in Saudi Arabia, are still massively oversubscribed on the books.
Absolutely. And there are buyers from pension funds, insurance companies, local bank treasuries, the fund management companies, the retail investors. And the order book is explaining that. You're seeing 3 times, 4 times oversubscription for most of these issuers. Yeah. That just tells that there's going to be a demand in play, even if supply is going to go up for the rest of the year.
Yeah, Amol, really good to chat to you. Thank you so much for coming on. Amol Shitole, Mashreq Capital, head of fixed income. Now, coming up, the UAE warns Israel that annexing West Bank land would reconstitute a red line. We have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. The United Arab Emirates has warned Israel that annexation of Palestinian territory in the West Bank would constitute a red line. Assistant Minister for Political Affairs Lana Nusayba says taking over Palestinian territory would severely undermine the vision and spirit of U.S.-brokered Abraham Accords. Joining us now is Dana Khresh, Bloomberg's UAE bureau chief. I just want to take a moment to sort of reflag what she said, because it is very rare for the UAE, especially the UAE, to make statements like this, especially referring to the fact that Israel is potentially crossing a red line. How should we read this, Dan, and how significant is it that UAE are sending this very public message, not only to Israel, but to the rest of the world, that the annexation of West Bank would be deemed a red line in their eyes?
Exactly. It's a message, like you said, to Israel publicly, but also to the U.S. I mean, this is the strongest stance the UAE perhaps has taken ever since the war in Gaza started 2 years ago. And the UAE has been under pressure. Those Abraham Accords have been under the spotlight ever since that. Now, this, of course, because the West Bank is a red line, and when the UAE signed on the Abraham Accords, the West Bank was supposed to be part of a future Palestinian state, and that's what they agreed to when they signed on. I think the UAE now is trying to show that there is a red line. Now, Lana Nusaybi, in her comments, did not specify whether that means severing diplomatic ties or what the next step would be, or how should we actually translate those red lines, and that remains to be seen. Now, this relationship has been under heavy strain. If you remember, last month, Netanyahu dispatched his top aide, Ron Dermer, and that's what we know from our reporting, to speak to the UAE officials, and we know that he spoke to the UAE President, Sheikh Mohammed bin Zayed, and that was about, taking over Gaza City or their plans for Hamas, and also West Bank annexation. And as ever since Netanyahu took power again with his ultra-nationalist coalition, the West Bank has been a topic, and they want to annex that. And of course, comes after Finance Minister's comment that he wants to annex so-called open areas in the West Bank.
And let's not forget that Netanyahu himself is under pressure from far-right members of the coalition. They've got an election to think about next year. So all of that is going on in the background. But let me just zoom out for a second, because the Trump administration perhaps has this wider dream for the region, of other countries in the region also signing on to Abraham Accords. There were some reports about normalization talks with Syria, potentially even with Lebanon as well. The fact that you have, the poster child of the Abraham Accords saying that Israel are close to crossing a red line, what bearings does that have on other countries potentially also signing up to these Abraham Accords? And
exactly, from the quote that you mentioned, she said, undermines the vision and the spirit of the Abraham Accords. And that would definitely deliver a heavy blow to President Trump's main foreign policy objective in the region. One is to integrate Israel better in the Middle East, and secondly, expand those Abraham Accords to include the likes of Saudi Arabia. Right? So with Syria, with all the countries, everyone's looking at what the UAE is going to do now and what that red line would be. And it definitely undermines that foreign policy objective of Trump.
Dana, thank you so much for the reporting. Dana Khresh, Bloomberg's UAE bureau chief. Thank you. Now, coming up, Ghana's inflation cools to its lowest in nearly 4 years, supporting the argument for another rate cut. The details next. This is Bloomberg. Ghana Ghana's inflation rate falls for an 8th straight month to the lowest level in almost 4 years. The slowdown may convince the central bank to lower interest rates at its upcoming meeting on September the 17th. Our chief Africa correspondent, Jennifer Zabazaja, joins us from Johannesburg. So ultimately, the central bank is following the cues that are coming from the inflation rates that have been printing. How likely is it that following on from this print, the Ghana Central Bank will cut rates once again in September?
Right, Jumana. I mean, if we take a look at just that print that we did get on Wednesday, and as you were just noting there, the lowest in nearly 4 years, and also an 8th straight month of declines. This is significant for the new Mahama administration, also for a country that had been coming out of an economic crisis. If we just take a look at the last time we saw the MPC meeting in Ghana, they slashed the key interest rate by 300 basis points. Now it's looking more and more likely, and what we hear from analysts and economists is it's not necessarily if, but it's by how much. But still, it's important to take a look at what we've heard from the central bank governor in the past few meetings, especially when it comes to the data, because he notes that it is important to take a look at potentially some of the headwinds that the economy could be facing. And as he says in particular, second round effect shocks and external shocks. This is important because this is an import-driven economy. They import a number of things into the economy. Despite producing gold, oil, and cocoa itself, it still has been significant for the economy to focus on importing, and that could in turn affect what we do see with inflation and in turn what Ghanaians are paying. But still, if we hear from, or if we take a look at what the central bank has said over the past few months, they still expect inflation to get back to the 6 to 10% target range by the end of the year. And really then it's just a matter of managing any seasonal pressures that they may face, not just from importing, but also in particular when it comes to the currency, which has come under pressure over the past few weeks.
Let me just ask you about that. It's the third quarter has been a rough quarter for the cedi. What's going on there?
Yeah, well, it's important to note what we've seen from the cedi over the past year, Jumana. The cedi went from being the world's best performing currency just a few months ago, right next to the Russian ruble, to now over the past few weeks, as you were just mentioning there, the third quarter has been really detrimental for the cedi. And a lot of that, again, goes back to the imports and the demand for dollars that we are seeing locally. And so we've now seen the cedi depreciate for a 9th day, or for an 8th day, if you take a look at the Bloomberg, really, and 9th day against the dollar. And so the question, though, is will this continue to be more, will we continue to see more pressure as we move into the holidays as well?
Thank you so much. That's Jen Zabazaja. We'll be right back in a moment speaking about Middle East trends as well. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Treasuries rebound as weak U.S. job openings data reinforces bets on a Fed rate cut. Christopher Waller says the central bank should cut this month and continue. Chinese stocks slump as Beijing weighs measures to cool stock market speculation as concerns about a rapid $1.2 trillion rally mount. Plus, U.S. President Trump asked the U.S. Supreme Court to uphold his global tariffs after a federal court ruling deems them illegal. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. So picking up on some of the more positive price action yesterday for global stock markets, we had Wall Street end the session in the green. Similar theme for European markets. So some stabilization coming through versus the prior day. Today leaning towards the green as well as we get closer and closer to the event of the week. And that is the jobs report that's coming through on Friday. Yesterday's jobs opening came as a bit of a negative surprise to those watching the labor market data, showing that the numbers are the weakest. And I would say going back to 10 months. So that's the weakest data in the last 10 months on the jobs opening front in the U.S. Sort of sets the scene for the numbers coming through on Friday. 10-year yields also big rebounds we saw in fixed income. Global fixed income rallied back yesterday. 10-year treasury sitting at 4.22% now, so down 6 basis points on the day yesterday. And Brent also in focus, down 0.6%. We're going to pick up that conversation shortly and talk about some of the drivers there. Switching over, though, the past couple of days, we were also talking about all of the money going into safe havens. Gold making it another record high, breaking through $3,500. Silver also we spoke about making a new high, not seen since 2011, through $40 an ounce. But here you can see that the gold ETF complex has seen a huge amount of inflows throughout the month of August, perhaps in anticipation of the Fed easing cycle, and perhaps in anticipation of some inflationary pressure coming through from those tariffs. So all of that has aided the price of gold. Let's also check in on how markets in Asia are faring. Annabelle Jewelers in Hong Kong with this big Bloomberg scoop suggesting that maybe Chinese authorities are weighing up curbs to rein in the Chinese stock market. It's been quite the rally throughout the month of August, Belle.
Yeah, I mean, you're talking about $1.2 trillion in market cap that's been added just in the space of a few weeks. And that really has been one of the primary concerns, I guess, for regulators. Is it moving too far, too fast? What China more likely wants to see is sort of a more gradual bull market evolving, and that certainly hasn't been the case. And so we have this Bloomberg scoop this morning that's talking about maybe they'd be looking at measures to try and just slow it down a little bit, maybe some measures to curb speculative trading, for instance. We've had curbs in place on short selling. Perhaps some of those could be removed as well. And so these are sort of some of the measures that we're hearing from sources are being discussed, again, in mainland China. Whatever the case is, I mean, it's certainly a case of sell on the rumor and then think about the facts later, because you're seeing already that huge sell-off here across the board, but particularly more on those more innovation growth-led indexes as well. You can see here where it's also really showing up is in certain parts of the market that have been sort of the big beneficiaries out of this rally as well. Let's take a look at the semiconductor stocks, for instance. Cambricon. This is a name that has probably unknown to a lot of people until a few weeks ago, but has been discussed as sort of an NVIDIA competitor in mainland China. Now, really, it's a very far cry from that right now. It's a minnow in comparison, but you are seeing, again, that selling down. Given, again, that you just got sort of these investors maybe moving out of some of those more growth-led names. Where we are seeing upside, though, and this is an interesting one, is in the solar space, because overnight, actually, Bloomberg had an interview with Qatar Energy. This is a solar company. We had an interview with the CFO talking about the measures to curb overcapacity in the solar industry in China. And so they're talking about the steps that are being taken. That could actually build into the earnings picture moving forward. You can see there that stock closed higher, but certainly it's having a big bearing on the solar names, because when you take a look at the CSI 300, for instance, 250 of them are in the red. There's just a handful that are in the green, and it's solar that's leading to the upside today.
Yeah, for a change, I would say. Annabelle Jewelers in Hong Kong, thank you so much for the latest. Now, oil dropped for a second day as traders fretted that OPEC Plus may boost supplies once again. This comes as Goldman Sachs says Brent is set to drop to the low 50s, $50 a barrel next year on a global surplus. Joining us now is Nicolas Lua, Bloomberg's oil reporter. It feels as though the market sentiment towards oil is turning increasingly bearish. What would you say is the consensus view amongst the analyst community out there right now?
Glut. I think that's the big story that people are contending with, not just as we move into the fourth quarter, but as Goldman Sachs is saying, we'll see as we move into next year. The big issue really, Yomana, is that, we've seen OPEC bring back so many barrels. The 2.5 million barrels a day that they fast-tracked, all of that has already been returned, and, eyes are looking at what they're going to do this weekend. In addition to that, as you pointed out, Goldman Sachs, traditionally very bullish on oil. In this particular case, seeing things much more bearish moving into the end of next year, and low 50s. Now, that's a figure.
Yeah, well, we've got another OPEC Plus virtual meeting coming up this weekend, and obviously they finished the first round. They've completed the first round of putting back the voluntary cuts back to the market. Attention's going to turn to that second clip, the 1.66 million barrels per day. What is the expectation?
So I'd like to look at where we are today, and I would say that Brent is falling after plummeting a fair bit yesterday. There were news reports yesterday saying that OPEC would bring some of the second tranche we've talked about, the 1.66 million, a part of that, not all of it, back. Bloomberg has since, of course, checked with our sourcing, and actually what we are still hearing is that OPEC is still playing its cards very close to its chest. So all options still remain on the table. And it's not just, it's not guaranteed they will restore supply. Maintaining current levels remains on the table as well. And so the question remains open as we move into the end of the week and heading into the weekend meeting this Sunday.
Yeah, all right. All eyes on that meeting. Nicholas Lua, Bloomberg's oil reporter, thank you so much. Well, business activity across Middle Eastern and North African economies showed mixed trends for the month of August. The latest PMI data from S&P Global shows the UAE leading growth, while Kuwait and Egypt recorded contractions. Joining us is Khatija Haque, Chief Economist for Eastern Europe, Middle East and Africa at Mastercard Economics Institute. Good to have you with us on the show. Before we delve into the details of the PMI numbers that came through from the region, I just want to ask you sort of an overarching question about oil, given, the oil dynamics. We were just speaking about it with our reporter. He was saying that the analysts' expectation on the street is that we are going to see a supply glut come Q4, beginning of Q1 of next year, that could pose further downward pressure on oil. How have countries in the region done so far this year with a weaker oil backdrop? We talk about oil trading down, 8-9% on the year.
They've actually done pretty well, actually, given particularly the volatility around oil prices in the second quarter of the year. We still ended up with an average oil price in the first half of around $70 a barrel. So it wasn't enough to keep all the budgets in surplus, and we did see some of the countries needing to issue more debt, Saudi Arabia in particular, needing to go to markets to finance the budget deficit that they were running. But in terms of the impact on the economy, I think so far it's been quite limited. We've seen some cuts to capital investment spending in the budget in Saudi Arabia. That was down by about 30% in the first half of the year. But that obviously has been offset by increased private sector investment, including government-related entities. So that investment story is continuing, and I think that's helping to underpin domestic demand, not just in Saudi Arabia, but really across the region. That's been quite strong this year.
So let's pick up on some of the most recent PMIs, the numbers that came through yesterday. One of the numbers that really struck out to me, Saudi Arabia's PMI is still coming in at 56 handle, 56.4. I mean, you hear all these stories about potential slowdown in Saudi Arabia, cutting down on spending, yet the PMI numbers are telling you a different story.
So I think that is really reflecting private sector stepping in and helping to compensate for some of the budget cuts on the capex side. I think overall public sector investment is still quite strong, because don't forget the Public Investment Fund is driving a lot of these big infrastructure projects as well. And where we're seeing reprioritization, it still means that there is investment going on. It's just perhaps on the projects that are required in a relatively short time frame in order to host these global events that are coming up. But the other story, I think, in Saudi Arabia is that consumption is actually quite strong as well. So household spending has been very robust in the first half of the year. The latest data from the central bank is showing over 10% growth in consumer spending through July on a year-on-year basis. And that's being supported by job growth in the private sector. So that's helping to drive population growth in the kingdom overall. We're also seeing greater number of women entering the workforce, and that's helping to support household incomes, the rise of double-income households. All of this is really positive for the consumer story in Saudi Arabia, and I think that's been a driver as well.
And also people forget that those are some of the key hallmarks of Saudi 2030 vision. There's so much emphasis on the big mega projects and the line, but obviously you have more people working, you have private sector investment, you have women participating in the workforce, so all of that is very evidently showing up in these PMI figures. Super interesting. Let me ask you another question as it pertains to, we asked about oil, but I want to also ask you about tariffs as well, and just sort of how the region, specifically the GCC region, has weathered some of the uncertainties around tariffs. And obviously they were spared the most extreme tariff rates around the world, but still there has been a noticeable impact on global sentiment.
So the regional dynamics are quite different. The direct impact of tariffs is quite limited for our region because we don't export a huge amount to the US. Most of our exports go to Asia, particularly China, and also to Europe. So the impact is more second round. It's reflected in weaker demand for oil from oil-consuming countries in Asia, weaker export demand, or rather import demand from Europe. So the market for exports let's say, from Egypt to Europe is perhaps a little bit softer. So that external backdrop is a little bit weaker, and that has shown up in the PMI surveys, where we've seen export growth slow quite sharply this year. But again, that's been offset by a very strong domestic story, and that's underpinned both by the consumption dynamics and also the investment
One of the
story.
countries that stands out, though, in terms of PMI misses and sort of subdued PMIs is Egypt, still sub 50. Yesterday's number came in at 49.2 versus estimates of 49.5. What is going on in Egypt? Where are some of the headwinds coming from right now?
So a lot of the, drags on growth, I guess, have come from the structural reforms that Egypt has gone through over the last couple of years. But we're actually in a position now where most of the hard stuff has kind of been bedded down. We're starting to see a recovery in government spending and government investment in Egypt. I think the softer PMIs, again, are reflecting that weak export story, so the weak European demand story.
Right,
but we are, we're seeing rate cuts from the central bank in Egypt. We had 200 basis points last week. It's a significant amount of easing, and that's facilitated by slower inflation from a stronger Egyptian pound as well, continued investment from the Gulf, from portfolio investment as well. And so that story is quite constructive, I think, going forward. And in the first half of the year, the GDP figures were pretty strong. They were over 5% in terms of H1 growth. So I think overall the story is quite positive for Egypt.
Khatija, pleasure to chat with you. Thank you so much for giving us an overview on how some of the Middle Eastern countries, GCC and Egypt, of course, are doing. Khatija Haque, a chief economist for Eastern Europe, Middle East and Africa at Mastercard Economics Institute. Now for a look at some of the other stories we're following. Saudi Arabia and the UK have announced joint investment deals worth more than £360 million. The agreements unveiled at the Great Future Summit in London will support industries from financial services to technology and see the establishment of new funds to invest in the Middle East and North Africa. The UK is seeking to leverage its relationship with Saudi Arabia to win business for British companies in the kingdom, while also attracting investment back in Britain. Lebanon's defaulted bonds have risen above 20 cents on the dollar for the first time in 5 years. That's as investors wager the country's political and economic reforms are gaining momentum. The bonds have posted a total return of 250% since last September. And the rally comes after Lebanon pulled back from a 2-year leadership vacuum and formed a functional government. Now, coming up, Tesla's sales are plunging across Europe, even as demand for electric cars surges in the continent. We'll break down the battle for Europe's EV market after the break. This is Bloomberg. Cool, I don't mind. I'm just wondering if there's... Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Tesla is losing ground in some of Europe's biggest electric vehicle markets. New data shows sales plunging, even as overall EV demand surges across the continent. For more on what's behind Tesla's struggles, we're now joined by Bloomberg's Danny Lee. Danny, I was just looking at some of these numbers. New vehicle registrations for Tesla dropped 39% in Germany, 56% through the first 8 months of the year. Europe is increasingly a difficult market for Tesla. What do we point that down to?
Yeah, Jumana, good morning. So almost all markets where Tesla competes in has seen a precipitous decline. I think the only market where Tesla has seen year-on-year sales growth is Norway. But generally speaking, Norway is a market where almost all of its car sales are EVs. So it does see a pickup in that from the consumers with that kind of interest. But when you look at the broader consumer story in Europe, EV sales and plug-in hybrid sales are up year-on-year and year-to-date, like up 26%. So Tesla is really struggling. It's a much more hyper-competitive environment, and it's really not seeing any benefit. And Elon Musk has been putting that down to a transition and an upgrade on its best-selling Model Y vehicle earlier in the year. But that in itself doesn't explain some of the steep drops we have seen, and whether you believe him or or when you look at what the reality is on the ground. Now, even markets like Sweden, where the Model Y has been on sale, those sales have dropped like 87%. So clearly there is a broader struggle at play here for Tesla, who does only do EVs and doesn't do hybrids, for example.
Yeah, well, I remember when those car registration figures dropped a couple of weeks ago, I was surprised at the strength of the hybrid market in Europe. So that, again, probably doesn't really help Tesla in this case. But then you also had some really strong sales figures come through from VW. Their sales have been surging in Europe. So what is behind that most recent uptick for VW?
Well, for Volkswagen, they have been in the doldrums for a little bit because they've been trying to find their feet with their EV strategy. But now what they're trying to do is use some of the legacy, one of the legacy models that it had in the past several decades, the Polo, the compact hatchback, which is now putting an EV model onto the market, and it's going to use that as a defense against some of the wave of Chinese competition we are seeing in the European market from the likes of BYD and Geely Auto. That's going to go on sale next year for around €25,000 or just under that, and that's about $30,000 US. But hopefully by using some of the legacy around that, it can actually transition and propel itself into an EV era. But this does come at a time for Volkswagen where European sales overall for autos has been sluggish. There's been huge competition it has been facing in China, which it has really struggled in. And there's, of course, the trade and tariff narrative, the story, which has really hurt its outlook for the full year. So hopefully with the tailwind of more optimistic-looking sales it's seen in more recent weeks and months, it can translate that with this new relaunch of its EVs.
Bloomberg's Danny Lee, always a pleasure. Thank you so much for joining us on our show today. Now for a look at some of the other stories we're following. Apple is planning to launch its own AI-powered web search tool next year. That's as it steps up with competition with OpenAI and Perplexity AI. Bloomberg has learned that the tech giant is working on a new system that will be integrated into the Siri voice assistant. Apple has also discussed eventually adding the technology to its Safari web browser and Spotlight, which is used to search from the iPhone home screen. The aim is to release the service in the spring as part of a long-delayed overhaul to Siri. Abu Dhabi's main artificial intelligence firm, G42, is looking to sell a stake worth about $100 million in Presight AI. G42 will offer about a 2% stake in the data analytics firm to institutional investors, which would increase Presight's free float and boost its chances of inclusion in broader indexes. And coming up, we hear from the Chief Commercial Officer of Qatar Airways about the airline's business outlook. That interview next. This is Bloomberg.
Yeah, we were very excited about this market. It's a market with a lot of potential. Today we have about 40 weekly flights to the US. About 2 years ago, we had only 3 destinations. Now we're going to 6. We just launched at Atlanta. We're going to launch Charlotte very soon. So Boston was 1.5 years ago, and they're doing very well. Year on year, we grew 20% in the US. So really excited about the potential of the market.
Etihad Airways CEO Antonaldo Neves speaking to us about international expansion and a push for growth in North America. Well, Qatar Airways says its outlook for revenue remains solid. Speaking to Bloomberg's Avril Hong at the Goldman Sachs inaugural Asia Leaders Conference in Hong Kong, Chief Commercial Officer Thierry Antinori says the airline is focused on delivering the best value of money to its customers.
Good demand and a very good outlook in the passenger business. So we are satisfied with that, and we'll communicate more precise number soon. But we have now 5 months in our financial year, starting in April. And the passenger performance is solid with a solid outlook. Regarding cargo, the situation globally is a bit more volatile, but we manage it also according our plan because we have a strong agility at redeploying our assets and our 28 aircraft freighter fleets.
And solid outlook then for passenger yields as well, is the expectation?
Overall, the revenue outlook is solid, yes.
Okay. What about when it comes to some of the other bits and pieces of the puzzle? I mean, we have lower oil prices. Is that something that's being included in your pricing strategy that's being passed on to travelers?
Everything is including. For us, Qatar Airways as a 5-star rated airline operating a 5-star rated global hub, the only global hub in Middle East rated 5-star. It's about to deliver the best value of money and to adapt to the context. The consumer has to enjoy and the best value of money in premium cabin as well in economy cabin through the best airport in Middle East and one of the best airports in the world. And it's our job to adjust according to the context. It's like in a cockpit, you know, you have weather radars, and we have also in our management cockpit radars, and one of the element the radars are looking at the fuel price, but there is other elements, and at the end it's about to continue to progress with the customer experience, customer satisfaction, and the demand for the product of Qatar Airways is growing and growing, so people want to fly Qatar Airways and they like our brand.
That was Thierry Antinori, Chief Commercial Officer of Qatar Airways. And a look at equity futures before we head on, well, to the next show. But this is how markets are shaping up. S&P futures up 15 basis points. NASDAQ up 20 basis points as we gear up for the big event of the week. That is payrolls figures coming out tomorrow. Well, that is it for Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.